Hey gang, welcome to another exciting episode of Time in the Market, the investing channel with a long-term focus, or also known as the fourth best investing show shot in my neighborhood. Kathy down the street does really good stuff about crypto. I mean, I can't compete with that. Today I'm going to be talking about Vail Resorts, ticker MTN. These guys own a bunch of skiing resorts. They own a bunch of mountain resorts all over the United States. They've been expanding in the last decade. They own one up in Canada, a couple in Australia. They're slowly moving into Europe now. They just had their earnings call. Results were mixed. A bit of a miss in the latest quarter. Their fiscal year guidance for the next year was okay, but maybe a bit less than the market expected. Plus, with these guys, you always have to kind of think about, well, they guided for 890 minimum million in EBITDA last year. They actually achieved 830-ish or thereabouts, so big miss for the entire year. And that's why the stock is down as much as it is, down 14 or 11% rather in the last year to date, 5% in the last year, down 9% in the last 3 years, down 13% in the last 5 years. So it's been a mediocre investment unless you were a buyer during the pandemic lows, but that's the case for pretty much everything. Beyond that, this is kind of during their growth period. As you go further out, 10 years out, 18 years out, pretty good return, 11 to 12% CAGR before dividends. So probably a market beater in that time frame. But now they've reached a point where they are pretty big, and it's possible that they are starting to slow down. They're a mature company. They're dividend payers, so investors can depend on that, but know that they have cut their dividend in the past if they run into financial troubles, as they did during the pandemic. If there's a slowdown in business, they will be proactive in cutting their dividend. And that's kind of a good thing in my mind. That's not always a bad thing, but it's not a stock that's, a dividend aristocrat or anything like that. They will pay when they can, and they will cut when they cannot. So what do they do? Again, 41 mountain resorts that you're buying into here. Very much a solid business on that front. If you're into skiing, you've probably been to a Vail resort, if you ski in the United States at least, and maybe in Canada with Whistler Blackcomb. They have pretty solid industry fundamentals. If you think about what a resort is, it's a big, massive development on a mountain. There haven't been really any of these built since the 1980s. At least of scale. They have been consolidated in a way. Vail Resorts started buying up some of the smaller ones, becoming a bigger business, and they sort of own this integrated network within the resort model. It's not just the mountain and the lifts that they own. It is the restaurants on the mountain and next in the town next to them. It is the dining experience in the whole thing. It is the lodging experience in the whole thing. If you want to stay at the mountain, you are probably staying in a Vail Resorts owned property. If you are in a Vail Resort, if you want to get ski lessons, Vail Resorts will provide those for you. If you want to shop for gear or rent gear, Vail Resorts owns stores. If you've ever been to Vail, you might see a Patagonia store there. That's not really a Patagonia store. It's a Patagonia franchise that is owned by Vail. So a lot of the money spent at a Vail Resort goes to this company no matter what you're doing. They even do real estate in certain areas. They have, realtors that will allow you to work with them, and they'll, sell you a home that is in Vail or somewhere in one of these fancier resorts. And a lot of times skiing is a rich man's game. It's quite expensive to go skiing. Lift tickets can go as high as $200 on some of these fancy resorts, maybe even more on some of the other ones. And what they've done is they've pushed this model into more of a season pass model in order to integrate their entire network into the life cycle of a life pass subscriber. And we'll talk about that more. But what that leads to is, maybe they're paying a bit less than they would if they were buying lift tickets every time they go with a season pass, but they are buying from their stores. They are renting from their stores. They are dining at their restaurants. They are staying at their hotels and or Airbnbs or whatever they manage. And they've got a group of world-class resorts. If you are a skier, you've probably at least heard of the first couple here: Vail, Whistler Blackcomb in Canada, Breckenridge, Park City, Keystone. They have started expanding into Europe as well with a 55% acquisition in Switzerland. And they're mostly in North America at this point, a couple of resorts in Australia and that one in Switzerland. But if you think about skiing as a whole, the United States is a big ski country, but it's far from the best ski country. When you want to go skiing, you go to Switzerland, Austria, or France, basically in the Alps. That's where the world-class skiing is, so they're starting to expand there. But the United States still is pretty good on that front. And they have a bunch of local resorts as well in the Northeast and out west as well. So you can kind of see all of their resorts here. And the interesting thing about this is that changes in weather does impact their business model. Even in the last year, they mentioned, hey, the Northeast had probably a bit less snow than we expected, and that leads to a slightly more depressed skiing season for the Northeast. If you go out west in Tahoe, for example, they had a ton of snow. They had basically almost double the snow that they would expect in any given season, and that can be a bad thing as well because it's just hard to ski when there's so much snow, and it keeps people from actually traveling to those areas. So the nice thing about their season pass model, as they've kind of pushed that, is that it is an upfront commitment from people that sign up for the season pass model, and it's non-refundable. So people sign up for the season pass, in July or October, or July or September, or August. I've got my months messed up there. And they prepay, and it's non-refundable. So they kind of have an idea of what their winter season, which is where 70 to 80% of their business lies, will look like, and they can sort of have an idea of what their financials will look like. So it's more dependable, and it's essentially better for the business to lock in a lot of these subscribers to essentially a subscription type model, because even if they're going there more often, that is a good thing, because they're using their ski school, they're using their rentals, lodging, they're dining at the restaurants, etc., and they're making more money off of that. So you can kind of see their whole strategy is to push the subscription model because it gives you a decision before the season starts. It's non-refundable because it gives a ton of value to the guests, and there's a bunch of subscription price tiers that they can get. And for Vail Resorts, that's a good thing because it helps with guest retention. More people are skiing, which they spend money on these ancillary services. They have better guest satisfaction. If there's excess capacity, it can be used, and it maximizes the guest lifetime value, and that leads to strong and growing free cash flow generation. At the end of the day, these passes are a pretty good deal. If you think about skiing, sometimes lift tickets can be $100 to $200, and these epic passes, as they call them, cost $700 to $800 or less. Maybe it's now $900 for the best one, or less, depending on if you're going with a local pass or whatever. And they allow you to ski as much as you want at pretty much any resort that you want, with some limitations. And they also have agreements with other resorts that they don't even own that can be pulled into this epic pass. Which makes it that much more of a value. So if you think about the Vail Resorts Epic Pass, and even if it costs $950, you can compare that against something like an Aspen Unlimited Pass, which is just maybe to the Aspen Mountains. That can cost as much as $3,000. So it makes skiing a lot more accessible from that perspective, because $1,000 is a lot, but if you're skiing all of the time, it's a really good deal. And that's a good thing for Vail Resorts if people think that it's a really good deal and they ski more often, because people will rent from them, people will buy from them, people will eat at the restaurants, people will stay at their hotels, etc. And that leads to pretty solid free cash flow. And even during the pandemic, they still had positive free cash flow, even if they were cutting their dividend there, because they wanted to make sure that if more happened, they were kind of prepared for anything that happens from there, and that allows them to reinvest in the business, they reinvest into growth of their current resorts, but also gives them a flexible capital structure. They can buy back shares. They can, self-fund that expansion with cash, or they can issue a dividend, which they do, and it leads to a lifetime value. And you can kind of see that this year, even though there was East Region and Tahoe extreme weather, they had 2.3 million pre-committed guests. It didn't as much impact their revenue as it would if they had a standard lift business model where they, guests paid as they came. If less people come, but they've already subscribed, it's not a big deal. Now, obviously, it's a big deal if that happens every year, because if you live in the East or in Lake Tahoe and you're a subscriber to the Epic Pass, and you can't use it because extreme weather is impacting you more often every year, you're going to be less likely to renew it. But as long as it's a one-off thing, it's not a huge deal, and people will potentially renew their subscriptions. Now, it does still impact their business. It did lead to reduced resort EBITDA guidance, like we talked about in the beginning, simply because there's still, a good 30 to 35% of people who just go based on lift tickets. They don't have a subscription, and obviously their goal at the end of the day is to have as many people on the subscription plan as possible. They've been doing a good job growing that, even lowering the price of that pass to push more people into the pass itself. But at the end of the day, this is a risk for them, a big risk for them. If weather impacts continue to be a problem in the years ahead, that's certainly a risk to keep in mind as an investor, because if there's severe weather or more snow or less snow, global warming, whatever you want to call it, that is a big impact to them. And they're already in a spot where, especially in the Northeast, they're already running these snow machines most of the year because there's less snow, more warm weather in the winters, and that could cause melting issues. So there's probably spending, millions of dollars a year at every resort to run these snow machines. So obviously it would be better for them if it just snowed perfectly all the time, but that's not the case. But that is already part of their business model. But if it continues to get worse and worse and worse, it could be a problem. So looking forward, obviously they want to grow the subscription model, unlock ancillary opportunities, and just make it better. So the subscription model, there's benefits to their guests. You can kind of see that the season pass revenue has basically gone from a very small portion of their business to a good portion of their business, growing at a 70% CAGR. And the one interesting thing is that as you look at skiers in the United States, that number kind of plateaued in 2011 at about 10 million, and it started shrinking until maybe 2019, 2020, and now it started to grow again, maybe 2019 range, even before the pandemic, it started to grow again. And a lot of that is probably driven by some of these season pass things that companies like Vail have started to offer, where if you go to Vail once and it costs you $200 to get on for a day, you're better off just paying $800 or something like that to get a season pass. And you can kind of see that from 2008 to 2019 there's a big shift on how many people are accessing their mountains with a lift ticket versus the season pass. So now they're in a spot where almost 75% of the people who are accessing the mountains are season pass holders, and that's a pretty good thing. And as far as revenue goes, 61% of that is with the season pass. And you can kind of see that the lift is still better as far as overall lift revenue goes, because 72% of visits are pass visits, whereas only 61% of the revenue comes from the pass. So the lift is still a better revenue mix for them, but it doesn't cause people to come back as much as a pass goes. So you might as well get people on the pass because they're going to spend money on other areas. And this is just lift revenue, right? It doesn't account for lodging, it doesn't account for dining, it doesn't account for anything else like that. So the way they've driven that is they've really strategically priced this thing. The price has only gone up about 5%, and in fact it was reduced by 20% in 2022 to make it grow more, and you can kind of see that in the number of people that subscribe for it. And even now in 2024 it's still below where it was in 2021. So it is a really solid deal in terms of skiing. If you are a skier, if you live in any of these regional areas and you potentially go to Vail or one of the other, or Whistler Blackcomb once a year or something like that, certainly makes sense to own the Epic Pass. If you only go skiing once a year, it does not, right? So that's really what that's not who they're targeting, though. They're targeting the people who are coming back, and they're making them come back more often by selling them this idea that, hey, you bought this thing for $900. You might as well come back as much as possible, get as much use out of it as you can. And that benefits them because they can sell ancillary services to them quite well. And that's why they reset the pass price in 2022, and that led to really good unit growth in 22, continued to be high in 23. Renewal rate is relatively high. And they really want to do that more because it leads to more guests coming to Vail Resorts, more of them purchasing a pass, and more of them doing other stuff and enhancing the lifetime value of the guests. So that's really the idea behind the pass, the idea behind their business model. You can see that if you return on a pass, you're going to spend more money than if you return on a lift ticket. That's just the reality. And that's not even accounting for the idea of them spending more money on ancillary services. And if you're in a local area, you're not really in a destination area, there's still a lot of opportunities to increase this pass penetration in some of these local places. If you're in the Northeast, for example, you do ski a lot more often locally. but not a lot of these people are still purchasing a pass, which they want them to do. And they want to do the same thing on the destination side. The idea, like I said, you ski locally, you buy a pass. Maybe you think about, well, now I can ski at Vail, at one of the best ski resorts in the United States, or I can ski at Whistler Blackcomb, one of the best ski resorts in Canada, for free essentially because they have this pass. But obviously, you don't account for the travel other costs there, the lodging costs, the food, etc. But you might be more willing to go there, actually visit it once or twice a year, and spend more money at Vail Resort. So it's a really interesting model. Totally see why it would work. Obviously, there's some risks here in that their acquisition spree is still happening, but obviously they're not growing as quickly as they were in the past. They do have some debt on the books, a little bit of a debt overhang that they have to work down in the next couple of years now that interest rates are going up, especially. And the growth is slowing down. And if we are going into a bit of a recession, this is a discretionary expense for sure. Maybe it won't impact some of the rich people that ski, but there's plenty of lower middle, upper class people that still ski, and they're certainly going to cut back on skiing. The nice thing is that you have, as an investor, you have a pretty good insight into their season pass sales. They actually announced that with their earnings calls, and you can have a decent idea of future earnings mix simply because they'll say, hey, well, in the next year, we already have 11% revenue growth versus the same time last year when it comes to season passes. And as that season pass becomes more and more prevalent, that becomes more and more of a revenue driver for them. And that's a good thing. I'm going to skip a bunch of this stuff, blah, 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 blah. One other thing is that you can talk about ancillary growth, right? Ski lessons, gear capabilities. And what they end up doing with stuff like this is they already have this Epic Pass. Now they're introducing a My Epic Gear in certain resorts, which is another subscription service that you pay, let's say $250, and you can basically rent gear, whether it's boots or helmets or skis or snowboards. And they get it delivered to your, Vail Resorts hotel for free. Well, after you pay the subscription, and that's pretty cool. If you're somebody who rents gear all the time, maybe you're more willing to pay $250 a year, essentially, to add it to your Epic Pass, and that's interesting. So a lot of cool things about this business model. Again, it's a unique asset. You're not going to get a mountain resort built anytime soon. So if you want to get into the mountain resort business, this is the way to do it. So looking at their earnings themselves, you can kind of see about 8-ish% EBITDA growth on the bottom end. But like I said, in the past, this is for 2024 guidance. In the past, they've guided high and they've missed. So there's been some pressure. And a lot of that pressure has come on the back of increased costs due to inflation, right? At the end of the day, yes, they're increasing their season pass ticket prices. They're increasing their ticket prices in general, probably increasing the costs on the dining and lodging side. But they're also spending a lot more money on their employees. They pay, their employees anywhere from $20 to $21 as a minimum wage. And now that may sound pretty good, but some of these resorts are in very expensive areas. Some of these resorts require employees to pay for parking. And people, essentially can't afford to live there. They sort of work at these resorts because it allows them to ski for free, essentially. And it's one of those jobs that's like a destination job where, hey, if you love skiing, maybe you'll work here for a season or another. But they still have trouble with staffing, and they'll have to raise those prices, those salaries rather, and that could put pressure on their bottom line, because at the end of the day, this is an experience resort where they have to have really good customer service. And in order to do that, they may have to increase the amount of money they pay their employees, which they should. But is that going to lead to higher prices? Probably. Is it going to make it less and less affordable for people to participate in this sport? Because you have to remember, this is a very very costly sport, and if this is their peak skier numbers, skiing is generally an older person's game. Some younger people go if their parents like it, but the age of the skier has gotten higher and higher for the most part. Maybe it's dropping a little bit now with these season passes becoming more prevalent and becoming more affordable, but it's not a long time from now before these season passes become unaffordable again. You look 3 to 4 years out, are they going to be $1,200, $1,300 in order to grow revenue? And that is that affordable? But you can still see that the penetration of the season passes and this is what I'm talking about, through September 22nd, North American ski season pass sales increased 7% in units and 11% in revenue and sales dollars from the same period in the prior year. So that kind of tells you, and or at least gives you an eye of what the revenue will look like for the upcoming winter season. And that can obviously slow down because the season pass sales are not over, but it could get better as well. And then you still don't have an idea of where that other 20 to 30% of the revenue will be in the form of lift tickets. But at least it seems like the upcoming winter season is pretty good because that's important. Winter makes up, let's say, 80% of their revenue, whereas these mountains do have things to do in the summer, like mountain biking, etc. They're primarily a skiing destination. You can't do that in the summer in a lot of areas. So interesting stuff here. Revenue, this was a summer quarter, so not a lot to look into. It's more of how did they perform in 23, and you can see that their EBITDA was 834 versus 837 in 2022 due to increased costs, and that's obviously not amazing growth when you're a company that is very much dependent on growth. So what do their financials look like? The balance sheet looks okay. You've got about $562 million in cash, down from about 1.1 billion 2 years ago. They did buy back a bunch of shares not too long ago. Their debt is manageable, 2.3 billion in long-term debt, and I believe only 700 million of that is due. The principal is due before 2026, so they're in a pretty good spot to pay that off with cash on hand, and the fact that their business generates decent free cash flow, and they've got capital leases. From a cash flow perspective, what have they been using their money on? Obviously, capital expenditures are a big part of this business. They have to continually improve their resorts. They actually spent maybe an additional 170 million in the 2022 or the 22 calendar year CapEx plan to kind of shore up the results, spend more money, shore up their resorts rather, and that is expected to drop down closer to 180 going forward. That's kind of the norm. So they always have expansion plans, improvement plans, adding new gondolas, adding new lifts, etc., to access new parts of the mountain. And that's kind of the part of the business that is going to continue. They haven't taken on a ton of debt in the last 2 years, but they did during the pandemic. That resulted in a bit of a dividend cut as they wanted to shore up their finances. And they've actually repurchased some shares in the last year, but they've also never issued shares in the last couple of years. They do have some stock-based compensation, but it's not allowed. So their share count has been shrinking. If you look at their estimates here, obviously 2020 and 2021 were negative years, but growth has really slowed down. They were growing at 14% down to 12% before the pandemic. Big year in 2022, obviously, because people were kind of looking for something to do after being locked up at home. But now that growth is kind of slowing down, and the expectations are that it really slows down in the years ahead, unless they make some other acquisitions to kind of grow their resort book. But any resort they add now is going to be less impactful to the bottom line, simply because they're already at 41. And if they buy another resort, it's only 2% of the resort book. So whatever revenue that gets is not going to lead to huge growth, maybe 2% growth from a new resort or something like that. At the end of the day, though, this is a business that's really solid, right? Free cash flow generation essentially every year, including 2020 and 2021, shows you that they can really cut back on costs when revenue drops. Obviously, if people aren't showing up to the mountains, you don't have to run them. You don't have to staff them as much. You can go back to 2008. And even in 2008, they had positive net income during the recession, which is a really good thing to see. Do we have free cash flow here? We do not, but a solid business model in general. The question is, where does it go from here? Is it going to slow down significantly when it comes to growth versus what we experienced in the last decade? Because they had some pretty good growth years here, and a lot of that was just due to acquisitions and the Epic Pass becoming more and more prevalent and growing in price and getting a lot of enrollment on the books. But now that the enrollment is there, can they spin that off into additional revenue from all these ancillary opportunities? Can this My Epic Gear thing be a really solid acquisition? We shall certainly see about that. I do not have my... Let me open my Google Sheets here because I do not have my thing open, which I should have. Let's look at the financials here. Disclaimer first, this video is for informational purposes only, educational, entertainment purposes, etc. It is not investment advice. Please do your own due diligence before investing, and do not treat any opinions expressed in this video as advice to follow a particular strategy. So with that in mind, we'll kind of look at the ticker MTN. The stock is trading at 210.85. The market's open right now. It's 10:04 a.m., so it might change as I look at this. It's a free cash flow yield of about 4%, but that's off of a 2023 year, which was impacted by heavier capital expenditures. If we look at forward expected, it's closer to 6 to 7% free cash flow yield. That's kind of how the stock has traded in the past. If we look at its valuation, it's certainly traded lower in the past. It's gone as low as 4 to 5%, even as low as 3%. But that was during the pandemic, during the growth that came after the pandemic. The expectation that a lot of that might be baked in for a long time, as a lot of stocks had that baked in. So I don't expect that to be the case. They do pay a dividend. I'm expecting it to grow at about, let's say, 5% on a go-forward basis because they have the cash flow to support that. But note, if they do run into some financial troubles, they will cut that at the drop of a hat because they want to make sure that their business is safe and secure. So management is ready to do that. They have bought back shares essentially every year since 2018. They did a bigger buyback in 2023, which, obviously given where the prices were, it didn't turn out to be such a great idea compared to where it is today. But at the end of the day, I assume that there'll be some sort of buyback, maybe 20% on a go-forward basis. As I look at the estimates and kind of where they are, I would ignore 27 and 28 because there's only one person estimating, so I don't expect their margins to drop that much. But I think these are pretty aggressive given the fact that their cost base is going up. They're paying their employees more. Their revenue growth is starting to be a bit more anemic, so I expect some pressure on their free cash flow margin. So when this says 19.8 for 24 estimates, I'm using 18, and I'm assuming that the margins are going to improve slightly as the years go by, but I'm also assuming that growth is going to be relatively anemic, 5 to 4 to 3% in the next couple of years, which is a bit lower than what the market is estimating. And then free cash flow margins are going to end up kind of close to the expectations for this year on the top end. And part of that is I think CapEx expenses are going to be elevated as a norm going forward, simply because they have to do a bit more to maintain these resorts as they get older. And also the impact of extreme weather might be escalated, and that may cause them to have to invest a bit more in, snow machines, etc., things of that nature, to make sure that they are accessible and usable no matter the weather conditions. There's obviously a risk here with climate change impacting their business model because their business model is entirely dependent on the winter months. And if those winter months are less enticing to skiers to go travel, if there's more extreme weather that prevents traveling, or if there's less fresh snow, which is better to ski on, that could impact their business model. So that's something to keep in mind. That's certainly a risk there. So as I look at this, I'm saying, well, maybe by 2028, they're going to generate about $672 million in free cash flow, which is, just a bit more than they generated in 2022, which was a really good year for them. It's not that much growth in terms of free cash flow from a pre-pandemic normal year at 442. So that seems kind of reasonable to me. I do think those margins are going to be pressured, but if they can, do things on the cost competitiveness side, if they can improve their season pass penetration, they can obviously pass through more of the costs on the lodging and ski school and dining side and kind of improve those margins. But this is a business that's been relatively steady in their margins, and I hope that continues in the next couple of years. As I look at their free cash flow yield, I think we are looking at a new norm here where even if this thing was priced at 3 to 4% in the past because of really good growth, that's just not going to happen if the interest rates, if the risk-free rate stays where it is today. You're talking about 5% risk-free rates, and if that rises, this is obviously going to have a negative impact on stocks, and you're seeing that in the market right now. The expectations are that the risk-free rate stays higher for longer. So my assumption is that, at best, the free cash flow yield that the stock market will give a company like this with slowing growth, with potentially margin pressure, with some external risk in the form of weather, is in that 6 to 7% free cash flow yield. So I'm putting 50% of my scenario in that 6% cash flow yield, 7% in that, or 30% in that 7% free cash flow yield. And if I'm targeting a 12% pre-dividend target return because of all the risks I talked about, because of the shrinking growth, because of potential margin pressures, that puts a fair value on the stock at $168. So that's 20% off where it is today. And maybe that's a bit too high if you feel more comfortable with a 10% return, because after dividends, which I think is a not guaranteed dividend, you're at 14%. You're closer to 184. Based on these scenarios, the weighted expected return here is, including dividends, is 10.6%. And remember, if at 12% target dividend return, 12 pre-dividend, you're kind of talking about a 16% return after dividends that you're targeting here, or that I'm targeting here. And that's where I'm getting the $168 fair value price point at, that I'd be comfortable investing in this stock. Now, your opinion can be a bit different. I will share this spreadsheet in the description down below that you can play around with it. Just hit file and make a copy to use your own. And remember the disclaimer, this data could be incorrect in one way or another, and this spreadsheet is always updated, and I will not update this specific spreadsheet that's down in the link below, so keep that in mind. So where is the investment thesis here? Well, the thesis is they can get back to margins that they've seen during the pandemic in that 20% plus range. That growth can be higher here as you experience better season pass growth than expected, and or that My Epic Pass program really takes off, and that really leads to increased spend at their stores for rentals and new gear, etc. But outside of that, this seems like a reasonable assumption to me. Obviously, they can acquire a mountain or two. You have to keep in mind their debt. Their debt right now is at a 6.3% interest rate, which is pretty high when you compare it to some of the other stocks we've looked at recently. But the majority of it is not due until 2026 or beyond. Some of that debt is still off of some of the acquisitions that they got in the past. There's some debt that's at like 11 to 12% because those acquisitions were really small. So they can probably roll that over at lower interest rates. So it doesn't necessarily mean that their rates are suddenly going to shoot up to 12% or anything like that. But their debt costs are probably going to go higher than they are today. So if you think about that as a risk, that's going to put pressure on free cash flows. However, since they have so much time to drive debt pay down, because most of it is not due until 2026, they can utilize a lot of their free cash flow to pay down that debt. And they already have $500 million of cash on the books. So if you talk about their actual net debt, it's closer to like 1.8 billion. If you account for the cash and capital leases as part of this debt, that's actually pretty decent, pretty reasonable given their history of free cash flow and this being a free cash flow generative business. But for me, though, there's a lot of external risks that I want to take into account, and the fact that they're growing at a really slow clip. I wouldn't want to invest in this at today's prices. That's really just what I think. They do pay a solid dividend, so if you keep that in mind, and if you're targeting a dividend adjusted return of, let's say, 10%, you're there at today's prices, right? That's if you put a target return of 6% in here, plus the 4% dividend gets you to 10%, essentially. The fair value is slightly above today's prices. So if that's your target, the price today is reasonable. But if you're a bit more conservative because of what's going on in the market today, because of the uncertainty around rates, because of the fact that these stocks can drop 30% in a matter of weeks at the whims of the marketplace, I'd want something that gives me a margin of safety, essentially, right? So even if you're at a 6% return and you want a 20% margin of safety, you're sort of getting to where I am with my 12% pre-dividend return with my 16% post-dividend return. So that's kind of where my mind is at with something like this. I do like the company. I do like what they're doing. I do like their financials. Their debt's not a huge burden. They generate a ton of free cash flow. It's just that if you look out at something like this from a 10 to 20 year perspective, what does climate look like at the time? That is a big unknown for them because their business is so dependent on the winter season. Are you willing to take that bet if you're a long-term investor at today's prices? For me, I think I'd need a bit more of a risk window, and that risk window requires me to look for a higher return post-dividends. And if that return is 16%, then that means that I want to buy this at $168, which is 20% off of today's price. And that may seem unreasonable to a lot of investors, but to me, that's kind of what I want. I am a more conservative investor, and right now I'm in a ton of cash as I wait for some of these opportunities. There's certain stocks that I'm buying here and there, some of which I've talked about in the past on some of my videos, but there's certainly a lot more risk and a lot more reevaluation when it comes to some of these stocks. If your free cash flow yield, in my mind, is below the risk-free yield, then I'm not buying your stock, right? And right now, this is showing a 4% free cash flow yield. It's not really because of the negative impact of capital expenditures in that year. But if that capital expenditure becomes the norm, then this is overpriced, right? And I'm not really accounting for that even in this analysis, because my assumption is that the real free cash flow yield that the market is pricing it to is closer to 6.7%, which isn't that bad. But if you're not going to grow that free cash flow yield at 10%, then why would I invest in this over the market, right? I need some sort of better return, and that means that today's yield has to be better than the 6.7% that the market is giving it today. And in my mind, this is going to grow slowly. Margins are going to improve, but I need a better return. So that's my thoughts. Let me know what you think down below, what you think about MTN if you own it. Is Vail Resorts a stock you're interested in? Let me know your thoughts down below. Like the video, subscribe, and welcome to all the new subscribers that have joined the channel in the last couple of months since I started making these videos. And thank you for all the nice comments and all that good stuff that you've made in the videos below. I hope you are enjoying these videos. And if you want me to review any specific stock, leave a comment down below with that stock name and I shall take a look. But as always, thanks for watching. Have a good day and best of luck. Bye.